Welcome to the Deep Dive. We're here to cut through the noise, distilling complex information down to the insights you really need. Today, we're plunging into a detailed stock report for Abits Group Inc. That's ticker ABTS. You're in the software and services space. Our guide is a pretty comprehensive Trendlyne stock report. And our mission: to pull out the most important bits of knowledge from this frankly dense document for you. Just for context, as of July 3rd, 2025, Abits Group is trading around $5.09, and get this, it jumped nearly 29% just in one day. Pretty significant. Okay, so let's unpack this. The report kicks off right away with something called a DVM summary. That stands for durability, valuation, and momentum scores. And these seem, pretty central to how Trendlyne looks at a stock.
That's exactly right. Think of these scores as a quick health check, really. They all range from 0 to 100. 0 is generally bad, 100 is good. Simple enough. So durability, that's looking at the long-term picture, things like growth, cash flow, debt levels. Is it built to last? Valuation, that tries to tell you if the stock's a bargain or maybe if it's a bit pricey right now. And momentum is all about the short-term trend. Is the stock hot right now, bullish, or is it cooling off, bearish? Okay, so let's look at Abits Group specifically. The scores here are, they immediately jump out. Durability is marked as not eligible.
Not eligible. What does it usually mean?
It usually means the company doesn't meet certain basic criteria for that score, often because it lacks a long enough track record of, say, profitability or stability. It's a flag right away.
Yeah.
Then the valuation score is 28. The report labels that expensive valuation, so not a bargain.
Okay.
But then look at momentum. It's 81. That's categorized as technically bullish.
81. That sounds high.
It is high. So you see the conflict straight away, right? Technically strong, maybe expensive, and lacking that long-term durability signal. It's interesting.
Yeah, definitely interesting. Let's dig into that momentum score first. 81. Technically bullish. What's behind such a strong number?
Well, an 81 is, as you said, very high. It suggests really strong buying pressure and positive technical signals across the board. The report mentions it looks at over 30 indicators. And here's something else. Abits Group actually has the highest momentum score compared to its peers listed in the report. We're talking companies like Netflix, ADP, Paychex.
Wow, higher than Netflix. Okay.
Yeah. So what does that look like technically? Well, the stock is trading above all 8 of its simple moving averages, the SMAs.
All 8, short and long term.
Short and long term, exactly. And also above all 8 of its exponential moving averages, the EMAs. Plus, it's trading above 8 out of 9 momentum oscillators in the bullish zone.
Okay, so the charts look pretty strong then.
Very strong. The RSI, Relative Strength Index, is 64.7. That's considered healthy, not quite overbought yet. And the MACD indicator. It's above its center line and its signal line, both bullish confirmations.
So you've got this really powerful technical picture. How does that line up with the historical returns? Because the report mentions some frankly staggering numbers. A one-year return of over 760%.
762.7%.
And a 5-year return of 561%. I mean, What does that tell us about its recent performance?
It tells us that this momentum isn't just a recent blip. Those returns are phenomenal. They directly reflect that strong, sustained buying interest we see in the technicals. The high momentum score and those incredible returns go hand in hand. It suggests this stock has been, on a tear for quite some time.
A real rocket ship, like you said earlier. Okay, now let's flip the coin. Because we have that valuation score. It's only 28, signaling expensive valuation. How do we square that with a powerful momentum?
Yeah, that's the other side of the story, isn't it? A low score, especially below 30 like this, basically says the market thinks the stock is expensive. It implies that all the good news, all that momentum, it's probably already priced in. And for Abits Group, this isn't new. The report states its valuation score has been in the bad zone, meaning expensive 95% of the time over the last year.
95% of the time. Wow.
Yeah, and even compared to its peers, it scores the 4th highest, which actually reinforces that it's expensive relative to others in its industry. So definitely not flying under the radar from a valuation perspective. And this expensive tag often connects to the underlying financial health, or maybe lack thereof. If we look at the ratios section, it paints a concerning picture. You've got negative ROE return on equity at minus 8.6%. Negative ROA return on assets at minus 7.9%.
Okay, so not profitable on those metrics.
It's not profitable and not efficient in using assets or equity. Plus, its book value per share is 4.4, which is below the industry median. And the interest coverage ratio is minus 24.1. That's quite worrying. It means operating income doesn't even come close to covering interest payments.
Minus 24. Ooh.
Yeah. And net profit annual, also negative, minus 0.9 million.
So quite a few red flags on the financial health side. But There's this other point in the report, revenue growth. Annual year-over-year is stated as 299.1%, nearly 300% revenue growth. And it calls Abbott's a market leader in that area. How do you reconcile that massive growth with all those negative profit numbers?
That's a great question, and it's actually a classic profile for certain types of companies, especially in tech or high growth phases. That huge revenue growth, almost 300%, means they are absolutely succeeding at selling more and grabbing market share. The top line is exploding, but the negative profitability numbers, ROE, ROA, net profit, tell you that this growth is costing a lot. They might be spending massively on sales, marketing, R&D, maybe acquisitions, all to fuel that top-line growth. Or perhaps they just haven't hit the scale yet where revenues actually cover all the costs and investment.
So growth at any cost, maybe.
Sort of. It's growth-focused investing. They're leading the market in revenue growth, but definitely not in profitability. And the big question for investors is always, can they eventually convert that revenue growth into actual profit? And how long will that take? It's a tightrope walk.
Okay, so we have this real tension. Powerful momentum, amazing past returns. But then, these worrying financials and that expensive label. How does the Trendlyne checklist try to bring all this together? It's meant to be a kind of overall summary, right?
Exactly. The checklist looks across financials, ownership, peer comparison, and value and momentum to give a broader view. For Abits Group, the overall score is passing 61.5% of the criteria, which sounds okay, maybe, but the details really show the split personality of this stock.
Okay, break it down for us. What did it pass and fail?
Right. So financials. It only met 1 out of 7 criteria.
Only one. Which one?
Positive cash flow from operations, CFO, for the last 2 years. So it is generating cash from its basic business activities, but critically, it failed on things like consistent profit growth, sales growth consistency, high durability score, Piotrowski score, which measures financial health, low debt, strong ROE, and positive net cash flow overall. Basically, it makes cash operationally, but seems to spend it or more.
Okay, financials look weak on the checklist then. What about value and momentum?
This is where it gets interesting again. It passed all 4 criteria related to the bullish momentum.
So confirming the strong technicals.
Yes, bullish momentum score, trading above all the short and long-term moving averages, bullish candlesticks, check, check, check.
Yeah.
However, it failed all 4 criteria related to value or being a buy.
Failed all of them.
Yep. Not in the buy zone based on historical PE, not in the buy zone based on P-book value, and the overall valuation score doesn't signal affordability. It perfectly captures that tension. Technically hot, but fundamentally expensive.
Got it. What about ownership? Who's holding the stock?
Ownership is also mixed. It passed 2 out of 2 criteria showing institutional interest is there. MFs or institutions are buying in the last quarter, and their holdings have been rising over the past year.
So the big players are getting interested.
It seems so, but it failed the other 2 ownership criteria. Promoters, basically insiders or founders, are not buying or holding steady, and other insiders have actually sold stock in the past 3 months.
So institutions are buying, but insiders are selling. That's noteworthy.
It is. It raises a question, doesn't it? Why the divergence?
Yeah, it does. Okay, lastly, peer comparison on the checklist.
Peer comparison, it met 1 out of 2. It is giving better long-term returns than the industry average. We saw that with the 1-year and 5-year numbers. But its recent sales growth and profit growth are not better than the industry median.
Okay, so stellar past returns, but current operational growth isn't necessarily leading the pack right now, especially profits.
Exactly. So the checklist really doesn't give you a simple yes or no. It basically confirms the profile. Strong momentum, great past returns, but weak current financials, expensive valuation, and mixed signals from ownership.
It really paints the picture of the dilemma here.
It does. And just briefly on the shareholding details provided, it seems retail investors listed as others data hold the biggest chunk. And interestingly, while institutions were buying over the last quarter, according to the checklist, the specific data from May 2025 showed mutual fund and institutional holdings were unchanged that month. So maybe a recent pause. Hard to say from just that snapshot. The report also mentions management. Mr. Konglin Deng as CEO, Mr. Tan Wanhong as CFO. Both got $120,000 gross remuneration in 2024. There are also independent directors listed with their pay. Standard stuff, really.
Okay, so let's try to wrap this up. We've gone deep into Abits Group Inc. using this Trendlyne report. And what we've found is, well, a company with genuinely impressive momentum, unbelievable historical returns. But at the same time, it's flagged as expensive. It has some pretty concerning financial health numbers, and that checklist was definitely a mixed bag.
It really crystallizes a common challenge in investing, doesn't it? You have this company with, again, nearly 300% year-over-year revenue growth. That's huge. But you also have negative profits, negative returns on equity and assets, and that expensive valuation tag screaming at you. So it forces you to ask, if you were looking at this stock, what do you prioritize? Do you ride the wave, focusing on those strong technicals and that incredible growth story, hoping profitability follows? Or do you heed the warnings from the fundamental financials and the valuation, perhaps waiting for a better entry point or more proof of sustainable profit? How do you weigh those conflicting signals for a company like Abits Group Inc? It's something to think about.